Superstars channel. Glad you're here. Today we're going to learn about the percentage of completion method for recognizing revenue. Now this is an intermediate level topic, and so if you're just starting out, brand new to accounting, this is probably not the video for you, but if you're an intermediate student, this will help you understand the basic idea for percentage of completion. So here's how it works. It's real easy. So we've got a construction company when we get to a construction, and they get their name when we get to it because customers would ask, well, when are you going to come out and work on our building? And they would answer, when we get to it. So that's the name of the construction company. So their job here today is to build 4 miles of road during the months of June and July and get paid a grand total of $400,000. So what I did down here is I made up a schedule for everybody to organize the information, and when you're working on these problems, I strongly suggest that you make up a table also. It'll really help organize things and make it so much easier for you. So here we go. So on the first line, completion schedule. Well, they hope to complete 1 mile during the month of June and 3 miles during the month of July for a grand total of 4 miles. In June, they plan to build 1 mile. Now that's 1 mile out of 4, so that would be 25% of the miles complete. That's how you figure it out. And in July, they hope to do 3 miles. So 3 miles out of the 4 miles is 75%. So to say it all another way, in June, they plan on doing 25% of the work. In July, 75%, which will bring them to a grand total of 100% when they complete the job. 25%, 75% is 100%. So the revenue recognized. So remember that the grand total of the contract is $400,000. In June, if they get 25% of the contract done, they will have earned $100,000. 25% of $400,000 is $100,000. And in July, 75% of that $400,000 is $300,000. So $100,000 plus $300,000 is the full contract amount. This is the basis of the whole system right here. I'm going to put it in bold so it stands out just a little bit more. That is the key right there. If you can understand this much of it, you've got it made. So coming down, the next line is billing sent to customer. Now, this is an account that is very unique to the percentage of completion method. And it takes a little getting used to at first, but it's pretty easy. Its purpose is to not double count the assets, and I won't go into detail why it works that way. So billing sent to customer, $100,000. They're going to send a bill to the state of Colorado for $100,000. And in July, they're going to send a bill to the state of Colorado for $300,000, which would bring them to the full contract amount. And payments to when we get to it. So when we get to a construction is very fortunate. They sent a bill to the state of Colorado for $100,000, and they were paid $100,000. And in July, they sent a bill for $300,000, and in July, they were fortunate and received $300,000. So by the end of July, they received the full amount of the contract. So they're all paid up. When we get to its cost during the month, well, they hope to make a profit, and they believe that their cost to build that first mile will be $70,000. And the way that I drew up this example is that each mile is going to cost $70,000. So in July, if they build the remaining 3 miles, that'll come to $210,000 for a grand total of $280,000. 70 plus 210 is $280,000. And then finally, the last line here, when we get to its gross profit during the month. Well, if they earn $100,000 and it costs them $70,000, well, that means that their gross profit will be $30,000. In July, if they earn $300,000 and their cost will be $210,000, that means their profit will be $90,000. And for the contract as a whole, $400,000 of revenue, $280,000 of cost. Well, that means $120,000 worth of profit. There we go. So hope you understand so far. And if you don't, just back up the video and watch it again here. So down below here are the journal entries for June and July. And what I did is I highlighted June's information in yellow, and so I put June's journal entries in yellow so that way they stand out. And July's journal entries are highlighted in green, and so here we are. Here's the journal entries for July. Now what I did is I highlighted in this blue color 2 accounts here, construction and process expense and revenue. Same thing over here in July, construction and process expense and revenue, that these go on the income statement. So here's what I'm trying to say. All these accounts, all these journal entries affect balance sheet accounts, except for the journal entries highlighted in blue. Those accounts are income statement accounts. So I didn't want you guys to get confused. So most of the journal entries will show up on the balance sheet, and just these 2 right here and these 2 over here will show up on the income statement. That's it. So here are the journal entries. All four of them are pretty simple journal entries, and the journal entries for June are identical to the journal entries in July. They're absolutely identical. The numbers are different, but it's the same idea. The only thing that sets them apart is that in July the project is totally done. It's finished, and so this 5th entry here, we only do this when the project is complete. And what we're doing is we're closing out the project, and I won't go into detail here because I'm trying to just get you the general idea today. So all of the numbers are going to come off our chart. It's easy. So first entry, construction and process, cash. This first entry represents the amount of money that was spent, the cost, to do the month of June. So it costs $70,000 to do the month of June. This first entry here, construction and process asset, this is going on the balance sheet. It's an inventory account. It's going to go on the asset side of the balance sheet. So it's not an expense, but it's inventory. And we're just pretending in this example that we paid for everything with cash. Normally, construction companies would have accounts payable for supplies and wages payable to workers and overhead accounts, but we'll just use cash here. The second entry represents a bill that was sent to the customer. When we get to a construction, sent a bill, I've got right here, billing sent to customer, $100,000. So we're going to debit accounts receivable for $100,000 and credit billing sent to customer for $100,000. This billing sent to customer is not revenue. Usually we would credit revenue, but this is not revenue. It's kind of a strange account that's only used in this percentage of completion method. So anyways, send a bill to the customer for $100,000. This is the journal entry that you do. And then journal entry number 3, cash is coming in. The customer is receiving money. So we're debiting cash for the amount of money received. And if you're wondering how did we know that, well, we got it right off our chart right here for the month of June. And we're crediting accounts receivable for $100,000. Now the fourth entry, as mentioned, these accounts in blue go on the income statement. So what we're doing is we're debiting construction and process expense for $70,000 because that was the cost during the month of June. So expenses are debits, and we're crediting revenue for the amount of revenue that we're recognizing, and I've got that on the chart here too, $100,000. Now if that's all we did, our journal entry wouldn't balance. So what we're doing is we're putting in another debit to make it balance, construction and process asset, $30,000. So in other words, this $30,000 is the gross profit, but strangely, it's going to go on the balance sheet, at least for a while. Those are the journal entries for the month of June. On to July. As mentioned, the journal entries for the month of July are identical. They're all identical except for this very last entry, which closes things out. So here we go. The first entry, construction and process. This is going to go on the balance sheet. That's why I wrote asset in parentheses for the amount of cost that was spent in the month of July. So here we have $210,000 spent in July, so it's right down here. and we're crediting cash. Normally construction companies would credit all kinds of things. They would credit accounts payable, they would credit wages payable, they would credit taxes payable, whatever, but we're just going to imagine that they're spending cash for everything. Journal entry number 2, when we get to a construction, sends another bill to the customer, and it's a bill for $300,000. And where did I get $300,000? Well, I got it right off our chart right there. So, and this billing sent to customer is mentioned. That's an account that's unique to the percentage of completion method for construction contracts, and it works out pretty cool. And I won't explain exactly how it works, but its purpose is so we don't double count assets, which probably right now doesn't mean a whole lot to you. Third entry, cash. Cash here. Cash is coming in. The customer sent in some cash. So cash was received, $300,000, and we're crediting accounts receivable for $300,000. And this fourth entry, it's just like the fourth entry back here in June. The accounts that are highlighted in blue are going on the income statement. So construction process expense, $210,000. Where did we get that $210,000? Well, that was how much was spent on the project during the month of July. And revenue, they're claiming $300,000 worth of revenue, and here we go, we get that right off our chart also, $300,000. Billings sent to customers and construction in process. All this is doing here, this fifth entry, is closing out the accounts. We're done with this project. The project is finished and we've been paid for it, and we're moving on to another project. So this project has to be closed out, and that fifth entry gets the job done of closing it out. So there you go, folks. So that is just a brief little summary of what's going on with this percentage of completion method. And as mentioned, just in a nutshell, right here's the key. These numbers right here, this is where it gets its name, percentage of completion method. We have to figure out, well, how much work was done during the month, and how much revenue are we going to recognize each month. And then when we come to the journal entries, these journal entries are very, very mechanical. They're very standard, 1, 2, 3, 4. So in most of the months, we'll just have 4 journal entries. All of the accounts belong to the balance sheet. They go on the balance sheet except for these 2 here, highlighted in blue. And going on to July, the journal entries for July would be identical. Of course, the numbers are going to be a little different. And we have added this fifth and final entry to close out the accounts once the project is done. So folks, this is just an overview of the percentage completion method. Now, everything for this construction company went perfectly. It was the most perfect, easy to understand example here. And unfortunately, in construction, things normally don't go this smoothly. So, folks, I hope you enjoyed the video. See you next time. Over and out.